Alright, so in this video I'm going to do a recording on capital budgeting and specifically the M&M propositions. Just try and give some basic fundamentals. Just note that I haven't done this for a couple of years, so my answers could very well be wrong. So don't rely on it, but just use it as a means to kind of orient yourself. But I definitely use the textbook and other things to make sure that the answer is correct. So I'm just going to use this program here, so it's the best I've got right now, to draw my answers. So basically what we've got is you've got two propositions. So we've got M&M Proposition I and M&M Proposition II. And for both of these, the propositions, you have no tax and what occurs with tax. So in effect, there's four different variations. So M&M Proposition I has to do with the firm value, or the value of the firm, and the effects when there's no tax and the effects when there is tax. So we're looking in terms of capital structure. I'm just going to draw this diagram here. So that might be 100% equity. Right. And then the second capital structure here might be 50% equity and 50% debt. And what we're looking at in the first proposition is how does the overall value of the firm change when the capital structure is changed? What happens when there's no tax? And what happens when there is tax? Okay, so M&M Proposition II has to do with the weighted average cost of capital of the firm. So a firm has basically two sources of capital, really: equity and debt. So bonds or borrowings from the bank. And it's very simple with debt. It costs money to borrow debt, and so there's a cost of debt. And let's just say it's a bond, you might have to pay 8% per year in coupons to cover that debt. Now with equity, there's a cost because you've got to pay dividends to the shareholders. And so we have a cost of equity, and it's almost always higher than the cost of the debt, say 12%. And usually you'd see this as RE, and this is RD. It's the cost of debt, or what we would consider as R. Now, say if we take this one here, which is 50% equity, 50% debt, the weighted average cost of capital is just the average of these items, so the average is 10%. And when making decisions in the firm, they'll use this as their discount rate, because it kind of is the average of what it costs them to raise funds, whether that funds is through equity and shareholders or through debt, bonds or bank borrowings. So what the M&M Proposition II is looking at is, as you change the capital structure, how does that affect the weighted average cost of capital? And you're looking at what happens when there's no tax and what happens when there is tax. So that's the brief overview. So I'm just going to pause for a moment and we're going to move into the next section. Okay, so let's have a look at the M&M Proposition I with no tax. And we've got two scenarios, Company A and Company B. Now if we look at the capital structure of Company A, it's got 100% equity, and Capital B has got 50% equity and 50% of debt. So we want to look at how is the overall value of the firm affected by these different changes, or the different capital structures. So the way we can look at that is that the value of the firm, which is usually represented with V, is the present value of all future cash flows, which we've learned from in earlier topics. So if you look at it this way, let's take firm A and B and just have a look. So we start with the revenue of the firm, and let's just say it's $10 million for each firm. And then we want to look at the costs, and we're just going to say $5 million each. So we're looking at the income statement here basically. And that's going to give us earnings before interest and tax. In this case it's 5 million, and over here it's 5 million. Right, so there's no tax in this proposition, and also as part of the M&M proposition, or as part of these propositions, is there's no, what they say, transaction costs, which basically means, no interest. So we're not going to take into account the interest, and we're not going to take into account the tax. So in effect, our net income, which is the bottom line, is exactly the same at 5 million. So regardless here, the cash flows down to the bottom of both firms are exactly the same. The capital structure up here does not affect the cash flows, which means that the values of the firms are exactly the same. So the way they represent this is they say the value of an unlevered firm, which is company A, no leverage, there's no debt, is equal to the debt plus the equity, which is equal to the value of the levered firm, this one over here. What it means is, it doesn't matter how much debt you have, no matter how much equity you have, this is always going to be the same as this, meaning the value of firm A is always going to be identical to the value of firm B. And that's M&M Proposition I when you're looking at no taxes and no transaction costs. So the next one I'm going to look at now is M&M Proposition I again. So we're looking at the value of the firm, but what happens when there are taxes? All right, so let's have a look here at, see if I can draw it up here, M&M Proposition I with tax. Okay, so same scenario, you've got company A, you've got company B, and the capital structure for company A is 100% equity, and for company B, 50% equity and 50% debt. And let's just say here it's $10 million, which means there's $10 million of equity, and over here it's 5 million of equity and 5 million debt. So we've got the same amounts. All right, so let's run our income statement again. So we've got revenue, 10 mil, 10 mil. And our costs, same, 5 million here, and another 5 million over here, which gives us our earnings before interest and tax of 5 million, and the same here, so nothing's changed yet. Now this is where it comes different. In this scenario, there's no interest, so we'll just put that for interest. So that's 0, because there's no debt. And over this side, there is interest. Now, we need to know the cost of debt. So RD, in this case, to keep it simple, we're going to say it's 10%. So therefore, the interest paid every year for company B is $500,000. Now tax. Tax is 30% of this minus this. So there's none of that. So the tax in this scenario, at say 30%, is 1.5 million. Now in this case, you've got the EBIT, subtract the interest, which brings it to 4.5 million, and then tax on that. Now I'm making a bit of an estimate here. I think it's 1.315 million, or something like that. I haven't got a calculator with me. So in effect, what's happened is company B, because of this interest, has actually paid less tax, and the less amount of tax that's been paid is about $125,000. So by borrowing money, by having debt, the company's reduced the amount of tax it has to pay, and this here is what is called the interest tax shield, because in effect it's because of the interest, it's shielding the company from having to pay tax. So this amount of $125,000. So what this does now is it changes the value of the firm. So over here in scenario A, you've got the value, we call that the unlevered firm. And that's got a certain value. Now this one, company B, we've got the value of the levered firm. So this is still equal to equity plus debt, as was in the previous scenario. Now the difference here with the levered firm is its value is the same as the unlevered, so it's the same as company A, but you get a bonus. Plus, we work out the present value of the income tax shield. So basically, this amount here, down here, is basically increases the value of the firm because it reduces the tax that needs to be paid. So the value of company B has increased by the interest tax shield. So now we can say the value of the levered firm, or the value of company B, is the same as the value of company A, the unlevered one, but with the addition of the present value of the interest tax shield. And that is the M&M Proposition I with tax. Now you can take that further by taking into account the risk of insolvency, and that's later in the textbook, but this is the fundamental principle. So I'm going to pause that now and we'll move on to M&M Proposition II. Okay, so now let's look at the M&M Proposition number 2 without tax. And from earlier, what we're dealing with in this proposition is the firm's, let me just get over here, weighted average cost of capital. And what we're looking at is, by changing the capital structure of the company, how does it affect the weighted average cost of capital of the firm? So let's have a look. Again, same, we're going to have two scenarios, company A and company B. And same again, company A has 100% equity, and over here company B has 50-50 again, equity and debt. Now let's just say company A, we've worked it out and we know that its return on equity is equal to 10% in this scenario. So the shareholders expect to get 10% every year in returns in the form of dividends from this company, which has 100% equity. Right, so that's company A. And over at company B, what we can say is the return on debt is, say, 8%. So that's how much it costs to pay the bondholders or to pay the bank debt. Now the thing is, right this second, we can't say what the cost of equity is in this scenario. Now the reason is debt equals risk, because with debt you have to pay someone else back, and if you don't pay that person back, well, then they can seize your company, or they can wind you up and make you go bankrupt and those sorts of things. So by having debt, you're increasing the risk for the firm. Now as a shareholder, if there's more risk, they want a better return. So if they're getting 10% over here with 100% equity, they want to get a higher return on their equity over here because of the debt. So what we would call that is a risk premium. So investors want a risk premium for investing in company B because of the debt. Now the way we do that is we've got to take into account the debt to equity ratio, and that's the amount of debt, total amount of debt divided by the total amount of equity. And that's just a ratio which ultimately just tells us how much debt there is in relation to the equity. Now in the scenario above, the debt to equity ratio is just 5 million debt over 5 million equity, so the ratio is 1:1. And obviously the higher you go, the more debt the company has. So when the firm wants to work out the return on equity in this scenario, it's in effect, we're just going to change this. We're going to change this to RU, 10%, the return on equity for an unlevered firm. So if we make this RL actually, which would be the return on equity for a levered firm, So this is levered here with the debt. What it is, it's equal to RU. So straight away, it's at least 10%, the same as company A. But we now need to add on the premium. And the premium is calculated as such. So you plus, we're going to use the debt to equity ratio, and then we're going to take RU minus RD. And basically what we're saying here is, well, the return on equity is going to be at least the same as company A, but we're going to add in this part here, which is the risk premium. And what we're doing is we're taking the debt to equity ratio and we're multiplying that by the difference between company A's return on equity and our return on debt. And in this case above, that's 8%. So there's a 2% difference here. So if you add in this is 10%, that's 1, that's 2%. Therefore, our return on a levered firm is 12%. So what we're saying here is, because we've got debt, investors expect to have a higher return, and based on the debt to equity ratio, they would expect that return to be 2% higher and basically receive 12%. So the return on equity for this firm here is 12%. And that's M&M Proposition II without tax. So I'm just going to clear the screen here. There's not much information on the M&M Proposition II with tax, but the formula for that is super simple, and you've already covered it in previous weeks. Let me just get to the top of the screen here. There we go. So this is M&M Proposition II with tax. Now I'm not going to say much because the formula is in your formula sheet, and it is literally this. The return, or the weighted average cost of capital for the firm, is equal to the return on equity, E over E plus D, plus the return on debt, outside of 1 minus the tax rate, that's a T by the way, outside of the total debt over equity plus debt. And you'll see in your formula sheet and what you've worked on in previous weeks, this is just the standard weighted average cost of capital formula, and all it's saying here is the return on equity multiplied by basically the percentage of equity compared to the total value of the firm, plus this is the return on debt, like 8% debt. This is the tax shield that the firm gets, the interest tax shield, or the benefit, the interest tax shield, and then this is just the percentage of overall debt in the capital structure. So it's this element here, the interest tax shield, which is introduced in M&M Proposition II when you're taking into account tax. Because as we showed earlier, there's a benefit, or the company pays less tax because of the interest. And I'm not going to say much more because that's really it. It's not even in the slides, this part. But that's the formula when you want to work out the weighted average cost of capital for M&M Proposition II with taxes. Okay, so that was almost 20 minutes. So hopefully that gives enough understanding that you can work out the rest and get a good mark on the exam.